Trading consistency is an illusion if you're only focusing on your strategy. We've all had those legendary sessions where we feel completely in sync with the market. And we've all had the immediate next day turn into a total train wreck using the exact same plan. It makes you feel like a fraud, but it's actually just proof of a deeper issue, the consistency problem. Your edge doesn't exist in a vacuum. It relies on your emotional state, your preparation, and the mental baggage you carry from the day before. In this episode, we're going deep into the framework that stabilizes your psychological baseline, not to eliminate bad days entirely, but to ensure they never break your account again. The consistency problem is specifically when your performance varies significantly not because of market conditions, but because of you. When the same strategy, in similar market conditions, produces dramatically different results session to session, depending on something you can't consistently identify or control. When your best self and your worst self feel like genuinely different traders, not just different outcomes, but different decision-making processes, different emotional responses, different levels of patience and discipline and clarity. That gap is not random. It has causes. Specific, identifiable, addressable causes, most of which have nothing to do with the strategy and everything to do with the psychological environment you bring to the session. A professional golfer has a swing that produces a specific ball flight when executed correctly. But the same swing, under pressure, after a bad hole, with a poor warm-up routine, executed with tense muscles and an anxious mind, produces a completely different result. The technique hasn't changed, but the conditions for expressing it have. Trading is the same. The edge is there. The question is always whether the conditions for expressing it are also there. There are 5 specific psychological variables that most traders never explicitly track. The first is a carryover emotional state. Every session doesn't begin from a clean slate. It begins from wherever the previous session left you. A session that ended with a significant loss, a rule violation, a trade held too long out of hope, that session's emotional residue carries into the next morning, whether you're aware of it or not. The cortisol is still slightly elevated. The confidence is slightly lower. The risk tolerance has shifted in ways that don't show up in any pre-session checklist, but absolutely show up in live trading decisions. Your bad days are often not about what happened that day. They're about what you carried in from the day before. The second is sleep quality. This one is embarrassingly simple and persistently underestimated. Sleep deprivation reduces prefrontal cortex function, the part of the brain that handles impulse control, risk assessment, and rational decision-making. A trader who slept 6 broken hours versus one who slept 8 solid ones is not operating at the same cognitive level, regardless of how similar they feel at the desk. The research is unambiguous. Even mild sleep insufficiency produces measurable degradation in the quality of complex decisions. And trading is nothing but complex decisions, made continuously under real-time pressure. The third is pre-session emotional loading. What happened in the hours before market open? A difficult conversation, financial stress from outside trading, physical tension from skipping the morning routine. These are not trading problems, but they load the emotional system before the first candle opens, and an emotionally loaded system responds differently to the same market stimulus than a settled one does. The trade that would have been evaluated calmly under normal conditions gets processed through a filter of pre-existing stress. The decision that comes out the other side looks like a trading decision, but most of the time, it isn't. The fourth is the recency effect. The disproportionate weight the brain gives to recent outcomes when assessing current probability. After a winning session, the brain subtly overstates the likelihood of the next trade working. After a losing session, it subtly understates it. Neither adjustment is rational. Neither is deliberate. Both are automatic, and both shift the quality of execution in ways the trader can feel, but often can't explain. The hesitation on a valid entry the day after a loss. the slight overconfidence in a marginal setup the day after a strong session. Both are the recency effect distorting the quality of the decision without the trader's awareness. The fifth is preparation quality. Not whether you looked at the charts before the open, but the depth and intentionality of how you prepared. A session entered with clearly defined key levels, specific setup criteria written out, a mental model of the day's most likely scenarios, and a genuine pre-trade risk acceptance. That session starts from a completely different place than one entered after a 10-minute chart scan and a coffee. The quality of the preparation determines the quality of the anchor you have to return to when things get uncertain mid-session. Thorough preparation creates a plan to execute. Minimal preparation creates a session where decisions are made entirely in real time, which is exactly when the emotional variables are most likely to take over. If you've been trading for any length of time, you already know how this plays out. But here is the brutal truth about the consistency problem that nobody talks about. Bad days don't just happen. They generate each other. A bad session produces a carryover emotional state. The carryover emotional state degrades the quality of preparation for the next session. Because a trader who is frustrated or deflated after a difficult day is less likely to do thorough pre-session work the following morning. Degraded preparation produces a session with a weaker anchor and more real-time emotional decision-making. That session is more likely to produce another bad outcome, which produces more carryover, which further degrades preparation. The cycle feeds itself. This is why traders often describe losing streaks as feeling like quicksand. The more they struggle, the deeper it pulls. It's not just variance. The psychological variables that produce bad sessions are being reinforced by the bad sessions themselves, making each subsequent session harder to approach from a clean state. The good news is that this cycle also runs in the other direction. A well-prepared session tends to produce better execution. Better execution produces a more settled emotional state at the end of the day. A settled emotional state makes thorough preparation the following morning easier and more natural. And thorough preparation produces another well-anchored session. The positive cycle is just as self-reinforcing as the negative one, but it has to be deliberately initiated, usually by breaking the negative cycle at its most accessible link. Preparation quality. This is the one variable that is most directly in the trader's control, regardless of what the previous session produced. Let's be clear about what we're actually trying to do here, because the goal isn't to make every session identical. Some variation from day to day is completely normal. Markets shift, your energy shifts, the setups that show up aren't always the same ones. That's not a problem to solve. What we're after is narrowing the gap between your best and worst sessions, raising the floor so the worst days hurt less than they used to, and making the good days less of a fluke, less dependent on everything lining up perfectly, so they start showing up more often because you built the conditions for them, not because you got lucky. 4 things narrow the gap more than anything else. The first piece is a pre-session routine that doesn't change based on how yesterday went. Not a version for good days and a different one for bad days, the same routine every single morning, regardless of what happened the day before. Exercise, a specific sequence you go through before the open, your key levels and criteria written out, a deliberate moment to reset emotionally before you sit down. The routine's job is to reduce the carryover from yesterday and the pre-session loading from outside trading, to create as close as possible the same starting conditions every single session. It won't be perfect, but the trader who has a consistent routine narrows the gap between their best and worst days more than almost any other single practice. The second is a session state audit before trading begins. 5 minutes, no charts. a genuine assessment of where you actually are emotionally right now. Not where you think you should be, where you are. Did you sleep properly? Are you carrying anything in from yesterday's session or from outside trading? Is there anything about today's emotional state that you should account for in how you approach the session? Perhaps a slightly more conservative position size, perhaps a stricter entry filter. The audit doesn't prevent bad days, but it prevents the worst kind of bad day, the one where the emotional variables were present and visible, but never consciously acknowledged, and so they ran the session unchecked. The third is the post-bad day reset protocol. When a difficult session happens, the most important thing is what you do in the hours after, rather than during it. Close the platform. Do something that physically moves the cortisol out. Exercise, a walk, something that gives the nervous system a chance to reset. Then, before the next session's preparation begins, review the bad session in writing. What were the variable readings that day? Which ones were off? What specifically would have been different if one of those variables had been in a better state? That review turns the bad day from a source of carryover residue into a diagnostic tool, one that makes the next session slightly better rather than slightly worse. The gap between your good days and your bad days is not a mystery. It has causes, specific, identifiable, measurable ones. And most of them have nothing to do with your strategy or your knowledge of the market. They have everything to do with the psychological conditions you bring to the session, the preparation you do before it opens, and what you carry in from everything that came before it. You can't make every day a good day, but you can make the floor higher. You can make the bad days less bad, less frequent, and less likely to generate each other. You can build a pre-session routine that creates the same psychological starting point regardless of what yesterday looked like. You can track the variables that matter and learn your own pattern. And you can treat your worst sessions not as evidence that you can't do this, but as the most useful diagnostic data available to you. Consistency isn't a personality trait. It isn't something you either have or don't. It's a floor you build. Deliberately, systematically, one session at a time. By paying attention to the things that actually determine the quality of your trading, rather than assuming the strategy alone will handle it.